Basel 2, the pillar 1 as it is like your Basel 1 prescribed minimum capital requirements, because Basel wanted to encourage banks to use advanced risk management system in the banks, and at the same time incentivize those banks which uses very effective risk management systems. So if your internal risk management systems are good, the regulators thought we must encourage banks to accept risk management systems, and they should given an incentive by giving a small less capital. So that is how they have prescribed different methodology for computing the credit market and the operational risk. Credit risk standardized approach, internal based approach, IRB approach, and the market risk standard measurement method, internal methods, internal model methods, and operational risk basic indicator, standardized approach, and advanced measurement approaches. The supervisory review, like we discussed earlier, has to be the important part of the pillar 2 is the internal capital adequacy assessment process, basically going through the entire business lines and identifying those kind of risks which are not earlier covered under pillar 1, and a regulator to come and see, yes, the bank has done a proper assessment of all the risks the bank is facing, and if they find the bank is not doing, probably they will come and stipulate additional capital. And third part definitely is about transparency. So more disclosures. This basically will supplement or complement what has been prescribed for pillar 1 and pillar 2. So there are 4, supervisory review process is a very important part of Basel 2, though it expects that the internal process in banks for assessing capital adequacy in relation to risk profile, that is where the internal assessment of capital comes into the picture, and supervisory review of the internal capital adequacy process, which comes in what is known as SREP process, supervisory review and evaluation process. And supervisor always expect that the bank should operate above the minimum regulatory capital ratios. If they have stipulated 9% all the time, the banks need to be minimum 9%. And if the bank find, if Reserve Bank, the regulator finds that considering the risk the bank is facing, the capital is not adequate, they can come and stipulate additional capital. And how they do it? They can do it on-site, off-site, through off-site supervision, on-site supervision, through discussion with the management, or through the talking to the audit team, and try to find out through the public report. Now, when we discuss in the internal capital adequacy process, what was we said was the kind of risk which the banks is taking, but not covered under pillar 1, basically the credit, market, and operational risk. So some of the risks which are not fully captured under pillar 1 are basically the credit concentration risk or liquidity risk. When we are lending or exposed to a particular kind of industry, disproportional, one particular bank has more exposure to a particular industry compared to the industry average. The bank which is, if there is a problem with a particular industry, the bank is going to suffer. So that's the concept of credit concentration risk. And then the interest rate in the banking book, because the interest rate risk was thought to be only in the trading book, because bank also run a lot of mismatches in the banking book. If you have seen, the banks on the liability side, most of their liabilities will be for a shorter period, whereas the assets will be for a longer period. So there is a kind of a interest rate risk in the banking book. Compliance risk, and for the measurement of the credit risk, market risk, and maybe in the coming days for other kind of risk, banks will use a lot of statistical models. So basically these are, since they are used, because they are based on certain presumptions which goes into the model. So naturally, if the model assumptions goes wrong, basically your computation of the capital or whatever inputs, outputs, it may go wrong. So there is a risk on the use of models. So when we take mitigants, there is always a feeling that if you are secured by a particular security, there is no credit risk, but it is not so. because the collateral itself could face some deterioration in the value because of the market raise. So that basically is captured in the residual risk arising from the credit risk mitigants. And internationally, there was a lot of assets, loan assets were being securitized. However, since it was considered part of a trading book, earlier no capital was prescribed. So one of the measure which was prescribed now in Basel II is the capture the securitization risk. And these are the risks which were not at all taken into account. Pillar 2 also talks about risks that are not at all taken into account under Pillar 1. These are liquidity risks, settlement risk, strategic risk, reputation risk, pension fund obligation risk. We know that we have a huge liability towards the pension scheme which was introduced in the banking industry, but all the banks are not fully provided for. So that also needs to be considered for maintaining additional capital. And contagion risk is basically to capture the systemic risk. It depends on the size of the bank, and we will talk about that later. And market discipline, as we said, to complement what has been the changes which have been done in Pillar 1 and Pillar 2. Basically, all the stakeholders should know the kind of risk the bank is taking, particularly the shareholders, people who want to lend money, people who want to invest in the bank shares. So from that perspective, lot of additional disclosures have been prescribed for the bank, qualitative, quantitative kind of disclosures, so that the public really understand the kind of risk the bank is taking. Now there are some implementation issues. Basel II, though we said it is going to has tightened or has helped the bank to improve the risk management system, and definitely a path in the right direction. There are a lot of implementation issues. And one of the things which Basel II says is about in the advanced approaches, use of the internal rating. This itself is a big challenge for the banks, because all your rating system has to be acceptable and has to get validated before they are used for capital maintenance. And building up because all these models basically use the historical data for whether it is to calculate the probability of default or other risk parameters. So building up the historical data is a big challenge. Definitely it has a cost implication because of the systems involved, and then validation of the internal rating system that we discussed. Acceptable PD history in rating scales, we require at least 5 years to 7 years minimum historical loss data. Now this is the how, if you compare the improved risk environment, and how do you look at the improved risk environment and the capital requirement. If you see that if you improve on the risk environment, your capital requirement are going to go down. That is how the whole Basel path has been set. So if you look across the standardized approach, and in the credit, if you look at the compliance with the minimum requirement and ability to determine default probability, that is probability of default is basically what is the likelihood a particular kind of a customer will fail in the coming year. That computation has to be done by the banks in the foundation approach. And other two parameters like loss given default is basically if the customer who has defaulted, if he fails, what is the likely impact or the loss which the bank is going to incur. Basically, if a customer has taken a loan of 100 crores and he has defaulted, and if all his assets are sold, if you are able to recover 40 crores, the loss given default will be 60 crores, which is basically 60%. And the advanced approaches, basically all this determination has to be done internally. So the foundation IRB approach basically says the bank has to compute its own probability of default. This is done using the internal ratings. Bank must have a rating history of 5 years, and they should use migration analysis or any kind of analysis to arrive at the probability of default. A minimum 5 years data is required. And then using that, you can calculate the risk weight curve to be provided. And loss given default and exposure at default are to be provided by the regulator in the foundation IRB approach. So the key requirement of the advanced approaches becomes the internal rating. So that internal rating has to be done independently, and the business lines should not get involved. Like the business credit people in the credit department should not get involved in credit vetting of the credit rating. So it has to be independently done. And independent review of the system itself is an important thing, because these are quite technology intensive systems. So there is a need that all your rating systems need to be vetted externally by the competent people. So market risk, basically there is no change as far as the market risk computation is concerned. So the three methods, maturity method, duration method, and the internal model method remains the same even under the Basel II. Now, how do you calculate the capital charge for market risk under standardized duration approach? Basically, the capital charge for market risk comprises of two elements. This is one addition, because we have seen the trading book earlier was thought to be exposed to only the market risk. But banks started investing in a lot of private sector investments. They are additionally exposed to what is known as the credit risk, or in this case specific risk. Specific risk is the risk specific to a particular issuer. So the capital charge for general market risk is basically accounts for the interest rate risk movement. So when you are invested in a fixed rate bond, basically when any change in the interest rate will impact the price of the bond and accordingly the portfolio value. So if the interest rate goes up, we know that the inverse relation between the interest and the market value of the fixed rate bonds. So modified duration of the security into the market value of the security and into the assumed changes in the yield. This basically will give you the change in the value of the bond because of the interest rate movement. So modified duration of the security is a measure of the sensitivity of the bond to the interest rates, and then the market value of security is what it is today, and if you multiply by that what is the assumed interest rate change, that will give you the kind of general market risk for the interest rate. And as far as the specific risk is concerned, so this is basically because if you have invested in a AAA bond and if it has migrated to AA, in addition to and if there is a change in the interest rate as well. So in addition to the interest rate, there is a possibility that the downgradation also will bring down the value of the bond, which may necessitate additional provision of capital. So this basically the way the market risk capital charge is consolidated. So for all the interest rate instruments, you will have general market risk and specific risk. And in additional point which is taken here, when you put all your interest, the interest rate bearing bonds according to the maturity, and you do it different, the corporate bonds, sovereigns, and there is always a netting which happens vertically and horizontally across the maturities and across the securities, and options normally being an used for hedging those kind of exposures, interest rate exposures, that netting also happens across the instruments. So basically to take care of this disallowances, so that to take away the benefit of netting, so vertical allowance, disallowance and horizontal disallowances are charged in addition to the net position, and specific risk we have seen is part of the credit risk or on the particular issuer. Equity also has the kind of general market risk, specific risk, and foreign exchange and gold will have to the extent of the open position. So that when you add up the interest rate risk, equity risk, and foreign exchange risk, what you get is a total capital charge for market risk. Now the operational risk under Basel II, they have prescribed three approaches. One is the basic indicator approach, second one is the standardized approach, and the third one is advanced measurement approach. And the basic indicator approach is the most simple one. Basically it has a beta factor of 15% on the gross income. Basically, when we say gross income, it's basically the net interest income and the net non-interest income. So the 15% of sorry, I said beta, but basically it is a alpha factor. So alpha is 15%, which is set by BCBS, which is accepted and followed internationally. We know that the banks do have activities in different business lines, and each of the business line has its own risk profile. So the basic indicator approach, as far as operational risk is concerned, irrespective of the activity undertaken by the bank, some bank may be very, very active in trading. Some bank may be only lending into the most secured part of the lending, that's the mortgage loan. Still, both were having the same capital charge. Probably standardized approach was brought in just to encourage those banks to take more kind of operational risk management approaches to reduce the operational risk by specifying probably a higher beta factor, or the what is used as alpha factor in the basic indicator approach. Depending on the business line, the higher beta factors are for those activities wherein historically it has been proved that they are always are exposed to higher operational risk events. So this basically a standardized approach prescribes the highest betas for corporate finance and trading and sales and payment and settlement, because these are very, very people, technology and process intensive. That is where you will find the beta factor is higher for them. So exposure indicator in each of the business line is basically the gross income coming out of the business line. When you add up all the business line income, basically you get what you get as a gross income in the basic indicator approach. So for the advanced measurement approach, which is very, very sophisticated, it's very, very data intensive. They have prescribed the business lines which are the same, which are used for standardized approach. There are 7 event type which under each of these business line. So you need to identify historical data irrespective of and fill in this 8x7 matrix. Basically you need 56 kind of data requirements, because suppose we are talking about failure of loss to the bank in a fraud in retail banking. So you need to capture what was the kind of loss the bank has incurred because of frauds in the retail banking. So that is the kind of requirement, and most of banks may not have the data to fill in all the cells. The approach is to get all the historical data and probably then do a sort of a modeling of all the historical data, and then try to, based on the historical data, try to compute the capital requirement. Now one of the reason why Basel II was blamed was they say just though the Basel II was around, still the crisis happened. So basically they say one of the reason for that was the capital arbitrage between the banking book and the trading book. Most of the securitized bonds which originated from the banking book sat in the trading book with most of the investment banks, and probably one of the reasons for that was the lesser capital charge, and and that's one of the reasons. And the derivatives were also not captured properly for the risk exposures, and liquidity was another reason. The liquidity is one of the main factor which has resulted into the global crisis, because a lot of banks were relying on a short-term borrowing and invested in long-term bonds which were originated out of the banking book assets. So announcement to the Basel II is basically the Basel 2.5. Basically there was an improved importance or strengthening the financial regulatory system, mostly in the trading book. So Pillar 2 guidance were enhanced, basically the supervisory part, firm-wide governance and risk management, and capturing of the off-balance sheet exposures, and managing the risk concentration. Some of the reasons why the global crisis was there, and managing the reputation risk and the liquidity risk, because one of the reason why people did not trust some of the banks was because of the reputation risk. So unless a reputation risk is managed, since banks rely on retail resources, unless you manage the reputation risk, it's very difficult to ensure a constant flow of funds. And the additional higher risk weights were because one of the factor which resulted into the crisis was a lot of commercial real estate and residential real estate got securitized, and sat in the trading book. So additionally, higher risk weights for CRE securitization were also proposed in the 2.5. And in case of a market risk, in internal model approach, instead of a normal VaR, stress VaR was prescribed. Stress VaR is basically taking the inputs on a stress condition, so not normal condition. So you have to stress the historical positions and then calculate the stress VaR, so which definitely will increase the capital charge. So there are some changes in the 2.5, Basel 2.5 in the Pillar 3 as far as the disclosures are concerned. So basically related to the securitization of the loans. Now let us talk about Basel 3. One of the reason for the crisis was that it was found that the banks did not have enough capital, and it was the quantity of capital, and also one of the important factor was the quality of the capital. Like Tier 2 bonds, most of the borrowed funds became part of your capital, and a lot of banks had a very good capital adequacy ratio, but when you really talk about the Tier 1, the ratios were comparatively less, and some of the banks which failed had a very low Tier 1 to risk weights ratio. So the Basel 3 2009 Basel Committee issued two consultative documents. One is strengthening and the resilience of the banking sector, and international framework for liquidity risk measurement, standards and monitoring. This was something which is the regulators has done for the first time, maybe taking cue from the crisis, that one of the reason for the crisis was the liquidity in the market. So the Basel 3 basically aims at more resilient banks in the banking system, and to have international framework for liquidity risk measurement, standards and monitoring. The objective, again, improving the banking sector's ability to absorb shocks, so that the risk of the banking doesn't get spill over to the real economy. So that is what has been seen in the global crisis. Though it was originally started with the banking crisis, it actually resulted into a global slowdown. So basically, the reforms which are proposed were in the micro-prudential norms to the individual bank level, and as a system-wide macro-prudential regulation, basically by prescribing additional capital to the systemically important banks which pose higher systemic risk. So the building blocks, raising the quality, that's the Tier 1 capital was raised from 1 to 6%, of its tangible common equity at 4.5, and total quantity was 10.5, including capital conservation buffer. You need to maintain capital for the counterparty credit risk. And one of the important ratio which the Basel 3 has brought in is the leverage ratio, which is basically when you take on the numerator the Tier 1 capital, and then the denominator, without considering the risk weight, the gross values of your assets, and also the credit conversion, taking the credit conversion factors and taking the off-balance sheet items and converting them into equivalent credit conversion factors and taking the credit equivalents. And addressing the systemic risk by prescribing additional capital for those banks which probably are larger in size and the failure of whom can pose a systemic risk. So additional capital charge for systemically important banks globally and domestically. And also it was seen that banks are normally keen to lend when the going is good, and probably when the economy is slow down, normally the tendency not to lend, because there is a apprehension that more of the loans and lent will become NPA. So to bring in this disparity, there's also a what is known as counter-cyclical capital buffer, so that you can draw from this buffers when the economy is slow down. So you create these reserves when the economy is good. When you are making good profits, create those kind of buffers and use them when the economy slows down. And minimum liquidity standards, again taking the clue from the crisis that liquidity has to be maintained in the banking system, and that the lack of liquidity, though you have a very good balance sheet, if you don't have liquidity, it could create a lot of problems for the bank.